Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates. The theme for the day was Fed members speaking about rate cuts, Eurozone PPI, and the Bitcoin ETF fiasco. Starting with the funniest, Bitcoin had quite a rough day yesterday with swings both sides after SEC's Twitter account got compromised. And in one of the compromised tweets, they mentioned approval of a Bitcoin ETF. And just for our listeners who are not aware, SEC is like SEBI in India. Fed members had somewhat of a dovish tone, but this assessment will be provided by JK. Morning, JK, take us through the latest developments.
Good morning, Swaraj. Yes, Bitcoin, of course, it's one of the most volatile financial instrument. And this, since October last, we have seen a 50% move in the Bitcoin price. It was around 30,000 at that time, and now it is a touched, I think, almost 48,000 yesterday. And yes, besides being a high beta product, it's also, susceptible to all this type of news, particularly this news about being allowed to run a ETF is making the rounds. But yes, it was shocking to see that the SEC site was hacked and false news was published to, create more volatility. But coming back to what is more relevant to us, yesterday's Fed member speeches were, yes, continues to be cautious. Despite whatever they said in the Fed meeting last and the dot plot, members continue to recognize that inflation is falling and say that inflation comes to target, they will cut rates, but they are not committing. And they also say the other side, if inflation does not fall, even they may have to consider raising rate again. So it's a very, very neutral statement that we're getting and completely data dependent approach. And so the market, I think they're still trying to push back against the market's excessive expectations and also trying to see that the financial conditions don't stay so easy, because that can lead to renewal of inflation pressures. And that is something like they would like to definitely like to avoid. We also had the ECB official, I think it was a more clear statement that we saw from Villeroy, and then he said that our decisions will be based on data. We won't be stubborn and we won't be rushed also. So it's a very clear statement that data, the way data comes, we will act. And we'll cut rate this year when inflation expectations are solidly anchored at 2%. So it's a very clear statement. Then if you look at the expectations of market now, it's somewhat moderated at 65.7% for a cut in March, but 6%, sorry, 6 cuts for the year is still priced in. And all this volatility, all these statements rather, in the absence of any major US data, help to keep the treasury yields range bound near 4% for 10-year and nothing major in the 2-year and the 30-year as well. There was some big auction for 3-year paper, but that was well received as well. All the market is bracing for this week's consumer price index data, followed by PPI the next day. And of course, the earnings season also starts in the coming days. So markets are sitting on their hands, waiting for better clues from the CPI number, which is relevant for bonds as well as the stocks, and also the earnings season that will be directly impacting the stocks as well. So once again, we did not see coordinated move in the US indices. The Dow was somewhat down, whereas the Nasdaq and S&P were on the positive side. Global stock index was mildly in the positives. That was par for the course because we did not have any fresh clues from the US economy. Even today, we don't have much on the slate as far as US economy is concerned. But yes, on the Eurozone, of course, we had quite a number of data in the recent past. We already talked about the German retail sales, which crashed, but then Eurozone retail sales that came was better. And in the recent days, we have actually seen Eurozone witnessing kind of bottoming across broad range of economic indicators like the German IFO, the PMIs, the manufacturing was slightly improved, and the consumer sentiment was also higher. bank lending data and cross-border activity. I mean, the trade numbers, which was published for France as well as Germany, showed an improved export sales, and these are actually supporting. And if you look at the bond yields, German bond yields have been moving up much more than the US, US yields as well. Importantly, we also had a wage data from Japan today morning, and it was, if BOJ was looking for evidence of growing wage pressures to justify change in their policy, it wasn't found in the latest data because it was a shocker with the nominal worker earnings rising by the lowest level in the last 2 years. So it pours cold water on any market looking for change in the policy. So accordingly, the average nominal pay actually rose by 0.2%, a steep deceleration from the 1.5% pace that was registered in October. So that's about the Japanese policy implication. Now, China is also hinting at more easing pressure with possible reserve ratio cut. And interestingly, today Chinese yuan fixing was somewhat higher compared to yesterday at 7.1055. Now, why it is significant is because between yesterday and today morning, there isn't much of a movement in other currencies. So countercyclical pressures are not really justifying. But although their fixing is well below where the market is trading, but keeping the fixing higher itself is an indication, possible indication that they're okay with some weakness. And Chinese yuan has actually broken the 7.18 mark. Technically, it looks very solid. Did not stay below 7.10 for long, and now again pushing towards 7.20. I think this is a pair that continues to attract a lot of attention. We should be focused on it, and more particularly from the point of view of Asian currencies, and the INR Chinese yuan will definitely draw a lot of focus. Other currencies have been range bound. Yes, euro is solid. As I said, a lot of data from Eurozone supporting the euro, and all dips have been well, supported with bids. On the INR, we did have a test of 8305 once again yesterday after the Bloomberg news about including Indian bonds in the EM currency index in a phased manner starting from September 2024. But that's it's just a sentimental value, nothing, no real value in terms of immediate flows. Therefore, the 8305 test once again failed to penetrate, and we had a move back to 8313 kind of levels, and it's already showing at those levels. So rupee continues to be range bound, definitely waiting for cues from the US CPI as well as perhaps the Chinese yuan trend in the coming days. Yes, interestingly, Japanese stock market has broken into a new high with fresh weakness seen in the Japanese yen, as well as the wage data possibly pushing back the interest rate changes from Bank of Japan. Definitely not going to happen in January. We'll see whether it will happen in March or later. Thank you.
Thank you, JK, for that comprehensive coverage. And just quickly summarizing, is that when it comes to Fed member speeches, they continue to be mixed. They are recognizing inflation is falling, and they are also saying that if inflation falls to target, they'll cut rates. But on the other hand, they're also saying if inflation rises, they will have to hike. So very neutral in that sense, little bit confusing. But ECB, on the other hand, is more clear. They are clearly saying that they are going to take a data-dependent approach. Markets are still pricing 6 cuts by Fed this year. And the key highlight of this week would be the CPI and PPI data from the US that would be in the limelight. And possibly we can see some range bound action still then. One more interesting point is on the China. China is hinting at more easing on a policy level. Even yuan fixing was a little weaker by the PBOC, which is a possible hint that the central bank is a little okay with a weaker yuan. And for rupee, we tested 83.05 yesterday, and markets moved higher back to 83.15 levels. So range bound action till US CPI and Chinese Yuan trend would give further cues on rupee movement. That's it from us today. Thanks for listening. Tune in tomorrow for the latest on the financial markets.